Hello, everyone. Thank you for joining us for this panel. The week is almost over. You can do this. But we have a really good panel for you guys. And before we get this started, I would like everyone on stage to introduce themselves. So say a little bit about yourself and what you do.
Sure, I'll kick it off. Hey everyone, I'm Jason. I lead DeFi at Axelar. Axelar is a decentralized full stack interoperability solution. In addition to bridging, which is what people think of cross-chain as, we also have something known as message passing, which is the ability to pass any payload across the 50 blockchains we support, which means you can build these chain agnostic cross-chain applications, which we think are the future of crypto and DeFi.
I'm Cynthia Wu, co-founder and CEO of Matrixport. Matrixport is an all-in-one crypto financial services platform. And this year we have joined the RWA effort by launching a sub-brand called Matrix Stock. And our first product is on-chain short-term treasury bill token, which is called STBT. And we'd love to explore how we can integrate STBT into the various DeFi ecosystem.
Hello, Nick from Gauntlet. We do financial modeling and simulation for basically anything that touches crypto, DAOs, protocols, blockchains, etc. Our focus has been in and around DAOs primarily in the lending markets for over 5 years, managing risks for Aave and Compound, doing incentives for Uniswap, SushiSwap, similar. Happy to be here.
Gareth from Tenet. We have a LSDFi focused network. We build our native products there, including LSDC, which is our native stablecoin backed by a basket of restaked LSDs.
All right, let's get this started. So the name of the game has always been yield. In the current interest rate environment, we see a lot of stables find their way into T-bill instruments or things that are similar like the DSR. It seems like the safest and most effective strategy right now is just to put your stables in there. Is it a good assumption, or are there other yield opportunities that people are missing on chain?
Maybe I will talk about the first half.
Yeah,
yeah, because we have definitely seen a tremendous initial traction when it comes to the product fit of on-chain treasury bill. I mean, we all remember last year that there has been a lot of blow-ups happening in the market where people, I mean, in general this year, also a bull market, it's a depression of yield opportunities across central exchanges and also DeFi. So there are $140 billion worth of stablecoins sitting in the market that looking for a more secure yield, and they would not be very comfortable to take counterparty risk like they used to be. So they would like to go for something really safe and secure, even though the yield might not be as sexy. So I think that creates a huge demand for looking for risk-free interest in real world. That's therefore this year you have seen STBT and various other similar products in the market that are trying to answer this demand.
yeah. And what makes your T-bill instrument at Matrixport different than other ones? And what are some differences you see in T-bill instruments?
I think there are a few basics. First, it has to be fully backed by treasury and tend to be people are looking to have the more liquid asset rather than a longer tenor asset. So for example, for SCBT, we have 90% of that in overnight reverse repo and around 10% in treasury bill that's less than 3 months. So first, I think given the current yield environment, people want short tenor. Second, and also transparency is also very important. So not only we prove that we are fully backed by treasury, and it's always our token representation is always smaller or equal to our underlying asset, but we also introduce third-party verification of that. So we have worked with Chainlink to provide the first proof of reserve on a daily basis, verified basically by the third party to provide the on-chain transparency. I think the third thing is really bankruptcy remoteness, because I mean, when issuing this asset, we're basically eliminate Matrixport counterparty risk by setting up an offshore trustee. Basically, it's often SPV, and the token holders has 100% of the basically has a lien on the underlying treasury bill. And the last thing I think is on-chain liquidity, because once you bring the asset on-chain, people would expect to trade it anytime, right, 24/7. So instantaneous liquidity is very important. So even though mint or redemption, there might be T+1 or even longer, but it's very important to provide them on-chain liquidity. So what we've been doing is that we have set up a curve pool, so that would allow the whitelisted address owner to basically swap in and out anytime they want.
Yeah. And Nick, you're the risk guy on stage, so I want to bring it to you about the risk with these T-bill instruments, whether it's with the products themselves or strategies on chain, whether it's looping on lending platforms or other things.
I guess if we're just thinking about how we'd assess it on chain, of like basically what we can see, not the credit risk from off chain or sort of what we're told by Matrixport or someone else. Liquidity and all those same sort of conditions matter. Like, how do you think about slippage? Where's the average trading volume? How is it bridged and used by liquidators when it needs to? What's the recourse when used as collateral? If it's an RWA, how is it used in a treasury, et cetera? To your previous question around like yield, it's definitely converged around T-bills. You can of course stack them, but if you want the simple solution that you don't have to basically add complexity or have some recursive strategy in and around liquid staking derivatives, yes, it's going to be around T-bills, and that sort of risk-free rate is as best as you can call it.
And we were talking before on the panel about how these interest-bearing instruments, you think they'll be used as a medium of exchange. Can you go into that more?
Yeah, for sure. I agree a lot with what Cynthia has said. At Axelar, we're working with a lot of the major real-world asset issuers as well as major stablecoins. One of our major partners is Ondo Finance, and they recently released USD Yield, or USDY, right? And it is this yield-bearing stablecoin that is backed by U.S. Treasuries. And in a DeFi context, right, a lot of users are coming on chain and are looking for yield in DeFi. And with the current environment, as Cynthia mentioned, people are really trying to be risk off and looking for yield in stable coins or like LSDs, right? So there's this powerful combination where if you form like liquidity with a yield-bearing stablecoin like USDY, there's an additional yield opportunity built on top of that, right? Because users can now LP with USDY paired against major assets. So in addition to getting the yield from the treasuries, you can potentially get additional yield from like the different DeFi strategies. Something else you have to keep in mind is that distribution is key when it comes to any kind of stablecoin. So I think having yield is great and all, but the next thing for it to really be a dominant stablecoin is that it has to have distribution. So with Ondo Finance, we're helping them bridge to multiple chains. The most recent chain is Mantle. And going to some of these L2s have distinct advantages, right? If you're a small retail user and you're playing with like $100 or something like that, the moment you do anything on Ethereum, just the gas cost will be more than any kind of yield you're getting. So having like distribution to cheaper chains, it makes it much more accessible for smaller users. And if there is enough volume going through, it will then be more widely adopted by DeFi applications like DEXs and lending protocols.
Yeah, I think that's the biggest challenge with not just yield-bearing stablecoins, but stablecoins in general, is increasing the monetary premium, increasing of people using the stablecoin for its sake of usefulness as money. So how does anybody here see that happening with yield-bearing stablecoins?
I mean, I think the key thing at the moment is actually from the user experience. So with the yield-bearing stablecoins, you've kind of solved the first aspect of having yield-bearing assets backing the stablecoin in the first place. But then it's what you do with that on-chain. And I think there's two components for that. One is the yield opportunities there to make sure that if you're going to have liquidity pools on different chains, on different networks, firstly, you need to incentivize those, and you need to have a method for doing that that encourages user adoption and growth. But most importantly is actually abstracting that away from the end user experience, who probably doesn't care what chain they're on, which network they're using, whether on an L2 or an L1. They just want to know what they're earning, what they're doing, and what the utilization is for that stable coin. And so I think something we really need to focus on as builders is that user experience, to abstract away all of the cross-chain complexities, all of the front-end complexities of DeFi into a really slick user experience.
Yeah, I couldn't agree more with that, right? Here at Axelar, our main vision is really creating this chain agnostic experience. And in order to do so, you really need to be able to have some kind of like message passing, right? Where you're able to like pass commands, combine functions into one. So all of this complexities, as you mentioned, is abstracted away from the user. And to give a concrete example, right? There's one very popular application recently that a lot of people have been talking about, which is Squid Router. What Squid does is it's leveraging Axelar's message passing to combine multiple swaps and a bridging transaction into one single one-click user experience where the user will simply select the source chain, source asset, destination chain, destination asset, and then they click a button, right? And the feedback from the users is that cross-chain has never been so easy. But there's a huge implication for stablecoins here as well, is that when you add on a messaging layer to the stablecoin, you can create an additional utility for that stablecoin. So I'll give you a very concrete example of something that was interesting that recently happened. When Base first launched, there was a rush of liquidity on chain, right? And I don't think the Base team was fully ready for people to bridge out. So there was only one way in, and people couldn't bridge out. You had like 100 million of trap liquidity on Base, before they formally launched. And Axelar was one of the first cross-chain solutions that provided, a way out for users. But because so much of the volume was going in and out of Base, going through like Squid Router, and in this case through the Axel USDC pool, which is just Ethereum Bridge USD, but with an Axelar messaging layer, that Axel USDC actually grew rapidly because all of the local dexes wanted to pair things with Axel USDC to capture some of the volume. So it was one of those scenarios where we saw a stablecoin gain adoption very quickly in the DeFi ecosystem with no incentive spend. Because usually that's the typical playbook, right? You introduce new stablecoin, you throw incentives at it, and then hope other people like pick it up. But I think this is kind of a flavor of what we can see in the future. In addition to creating yield, if you can add on a messaging layer and for it to be composed with other DeFi applications, you will have natural volume, natural utility that will there help with adoption.
I think I would like to just comment on that. I have been recently given a lot of thought on the distinction between a yield token and a stablecoin, which I don't think necessarily mean the same thing. I think for the stablecoin, the most important value proposition are probably three. The first is it's very stable, and it's the battle tested, right? The second is that it's liquidity, right? You want to get into, because it's a means, right, of transfer and payment. So you want to get into it and out very conveniently. Therefore, we need central exchange, DEX support, OTC support. That's very important. That's support of liquidity. The third one is use cases. You want it to be used on various user cases in DeFi and in CeFi, in cross-border payment and various other use scenarios. If you can achieve these three, you already have a pretty good stablecoin. I think yield, it's, to be honest, it's a bonus. It's not something that naturally would bring adoption. So that's just my thought. So I think this year we have seen a lot of yield-bearing stablecoin because the yield happened to be higher, right? But I think the real test is that when yield goes down again, would those adoption and use cases still has been proliferated? Yeah.
I think it depends where you're getting the yield from, though, because, yeah, I think this year we've seen a lot on the US Treasuries front and the focus there. But we've also seen a lot of the LSD-backed stablecoins coming in, and that's always going to be something where, while ever proof of stake exists, people will be getting the block rewards. There'll be staked assets that can be utilized in that way. And I think going forwards, when we look at new areas for adoption, there could be other real-world assets. There could be invoice forwarding, factoring, interest rate swaps, a lot of different products that we see trillions of dollars in volume in the real world that are not really on chain yet. And I think as more of those products that, yeah, it's only in the last year or so we've seen US Treasuries really coming on chain. And in terms of like a real world asset primitive, that's not that complicated in terms of structure. But there'll still be interest-bearing, yield-bearing opportunities there, and I think we'll start to see more of those assets coming on chain, and then they too can be utilized in DeFi in the same way to back stable coins and to act as like base assets within the DeFi ecosystem.
Switching gears a bit, I want to talk about ETH-pegged stablecoins, better known as liquid staking tokens, because I consider them very important stablecoins too, very essential to the ecosystem. They present a really unique opportunity for native on-chain yield. What are your guys' thoughts on LSTs and the most effective strategies for them, whether they be looping on an Aave, restaking with Eigenlayer, or other types of strategies? Yeah.
And I can take that from the Tenet perspective.
Yeah.
Obviously, for us, using it as restaking to Tenet and then backing the stablecoin with it is the simplest of the strategies available. Of course, you can then take that stablecoin, you can utilize it on lending protocols, you could do the same looping strategies. It all depends on your risk tolerance, and I think it's when you're building your own strategy for generating yield. It's how far down the rabbit hole you want to go. Do you stop at the restaking stage? Do you want to take on the risk of minting a stablecoin and having to monitor the price of your asset, make sure you don't get liquidated? There's a lot of automated strategies for that these days, like DeFi Saver, etc. Do you then go and provide liquidity on a DEX for it and reap rewards for LPing? But then you've got impermanent loss. If one of the coins goes off peg, you can have issues. So I think it depends on personal risk tolerance.
What is one of your favorite strategies that you've seen?
Personally, I think at the moment there's a really good opportunity to provide stable pair liquidity on Maverick protocol, as I think what they're doing in terms of a combination of UniV3 but with automated strategy management and adjusting your own liquidity curves is really interesting. And particularly on the stable pairs side, they've seen not just really good growth, but really good capital utilization. So their actual TVL is very low, but their volume is one of the highest for any DEX at the moment. And I think more interesting products like that will come out.
Yeah, we love a little bit of alpha, guys. But yeah, what you can say?
Yeah, there's actually a new opportunity for yield with LSDs that dropped this week. So this week, Axelar and Lido, as well as KyberSwap, announced a partnership where we're making staked ETH interoperable across L2s as well as in Cosmos. And how we're doing this is quite a unique structure, right? As some of you may know, native staked ETH is natively minted or already exists on most of the L2s like Polygon, Arbitrum, and Optimism. But they're not interoperable with each other, right? Today, if you want to move staked ETH from like Arbitrum to Optimism, you got to bridge it back to mainnet, which takes ages, and you got to bridge it back to your destination chain, which will take even longer. It's just a really poor user experience today, and nobody is really doing that. But we've been able to make natively staked ETH be interoperable and cross-chain swapped in less than 20 seconds with Squid Router and Axelar running in the backend. And how we're doing so is we actually have an Axel wrapped staked ETH, which is, again, just staked ETH with an Axelar's message passing. And then we're creating a pool on KyberSwap's concentrated liquidity model where there, as a staked ETH holder, you can basically LP for this pool, right? And there's no impermanent loss, and you're getting the yield from everyone that's doing the cross-chain swaps, as well as the initial incentives that Lido, Axelar, and Kyber is providing to bootstrap the pool. And for Lido's community standpoint, this is incredibly appealing, right? Because not only are you now improving the user experience by letting this staked ETH be interoperable without compromising security, but at the same time, it creates an additional yield opportunity on top of that. So we really think this is just the beginning, and this kind of architecture will be followed because it really applies for stable coins as well as other LSDs.
Now, although these strategies are really exciting, Nick, you're a risk guy. Bring us back down to earth. What are risks that we should consider with LSDs and these strategies?
There's never a free lunch. The lunch is a little bit cheaper now that withdrawals have been enabled. It's always been pushed at, recursive strategies in Aave or otherwise, like where we sort of have been managing risk for quite a while. I guess how you want to think about it is, what we're always echoing in papers or whatever else is it's a joint optimization problem. How do you think about that risk curve, but also like the interest rate curve and the liquidation bonus and where that liquidity is? The best proxy in our mind of obviously abstracting the UX and making that cleaner, or distribution is obviously important, but like, are liquidators comfortable taking exposure to the asset if they are liquidating it, right? Are they trying to do it atomically in a flash loan or something similar, or will they take price exposure to whatever staked asset or stablecoin or whatever that might be? Starting to be more so, and that has not always been the case, obviously.
Yeah, obviously. Yep. And does Matrixport have any LSD offerings? How does Matrixport view LSDs and ETH-pegged stablecoins?
Yeah, so at Matrixport, on the asset management part, of course, staking yield is always a very secure and attractive yield to most of our investors. So we do offer a various range of staking strategies. One is liquid staking. The other is native staking, and we also offer leverage staking. So I guess on the from the user behavior or mentality, from the liquid staking side, is that they do value, most of them are retails and large retails like whales. They do value liquidity probably more than the absolute yield. Yeah.
Yeah. Going back a bit to RWAs, there have been a number of opportunities that have popped up on chain. Do you guys see RWAs becoming as seamless throughout DeFi as payment fiat stablecoins as like Tether and USDC? And if so, how do we get there?
So I think we've seen a lot of real-world asset protocols over the years. It really, to me, started with Centrifuge back when they were doing the invoice factoring on chain. Now you've got a lot of US Treasury protocols, and I think we are seeing increased offerings on that front. And as an investor, I do see like a lot of protocols that are putting together decks for bringing real-world assets on chain. I think the biggest challenge, and it's something that protocols like MakerDAO have really been leading the way in, is how to properly structure them from a legal perspective so that ultimately the on-chain user has the right to enforce and to take possession of those assets in the real world should the issuer run into legal trouble, should they go bankrupt. You need to put in place the proper legal protections and structure to ensure that the people that are holding those assets on chain are actually the owners of those assets. And if we can solve that problem, then I think they're a brilliant asset for use across the DeFi space. But if you don't get that structuring right in the first place, then you'll run into all sorts of issues down the road.
And who's going to like pick up that baton in the DAO, right? Is it the delegates? Is it like the token holders that haven't delegated? Like who's going to pick that up? Obviously, there's like voter apathy and elsewhere, but like in recourse or a long legal battle, I don't know that anyone wants to be in the forum sort of doing that particularly. RWA is definitely interesting, like the use case for Maker, as you mentioned, but like even Aave with Centrifuge more recently, like Treasury matters, like that opportunity cost of having your governance token in Treasury just doesn't make sense. So diversifying there seems like a great first step.
Yeah, I think RWA is a very wide category, right? In real world, RWA could mean securities, bonds, public or private credit. It could mean precious metals or properties. I mean, all this, or fine arts and wines. I mean, all this in the future is possible to make way onto the blockchain through the RWA tokenization. So I guess depends on the category characteristics of the underlying asset. It won't be categorized as security token or non-security token, which would require a varied degree of permissionless. So I don't think it is and the DeFi infrastructure should be catered to that to offer compatibility with a various degree of permissionless. That's also kind of coupled with different KYC requirements. So I think DeFi is infrastructure and RWA is asset class. So I don't think anything happen on DeFi from the RWA tokenization unnecessarily all need to be permissionless.
Yeah, I like how you frame that DeFi is this infrastructure layer and RWA is an asset on top of it that happens to use DeFi as a tool to proliferate. Yeah. Also, moving forward with RWAs, there's obviously a lot of regulation and red tape and yellow tape to deal with. How do you guys view regulation and compliance, and does it affect current or future strategies in any way?
We're not going to drop the delegate bag. Sort of, we live in the forums. We're going to live and die by sort of DeFi governance. We kind of approach it in a similar way to like proxy voters in TradFi, Glass Lewis, or ISS, where effectively you want to have frameworks and guidelines, very public. Not only like existing delegators, but like regulators can come view these. They understand how we approach it. They understand that this is real governance. This isn't governance theater. You'll start to see, or we're starting to see draft bills, at least in the US, in and around sort of enforcement and concerns over control. But for the existing time period, we're going to stay pretty active in governance.
I mean, I think regulations have been central to the stablecoin world for a while now. I mean, we saw back on Black Thursday, some of my personal friends ended up being sued as a result of what happened with MakerDAO there. You've then seen things like Reflexer that focus more on censorship resistance and not having any attack vector there from the regulators. Once it's deployed, it's deployed. It's an immutable protocol. And so from my perspective, I think having the least attack surface vector for a regulator to come in and stop your protocol in the future, because you remove and abstract away any areas that they can come and say, you're managing this, you need to do KYC, you need to check your users, etc. If you're using either a true DAO structure or an immutable structure, I think that's got to be the way forwards for the industry from a DeFi perspective to really decentralize it. I think it's something that Maker was founded on, those principles. I think they did it really well. I think other protocols are building on top of that now, and it's something that's core to me in how stablecoin protocols should develop, whether it's from the front end, whether it's from the DAO governance structure, etc. Everything needs to be correctly done so that there's the least surface for attack vectors there.
And with regulators, they've done a lot better job understanding stablecoins, but there still is a ways to go. So what is the proper way to construct a narrative and a story to regulators that stablecoins aren't just another form of money, but a better form of money than traditional banks and whatnot? Anyone?
I don't think they'd be very keen on accepting that view, and therein lies the problem. They don't want to see stablecoins as a better form of money, a new form of money. They want to control the form of money and the narrative, and I think that's where
like
stablecoins are an attack on the system, actually. And
yeah, I guess that's where CBDCs come in.
Exactly.
So then central banks are able to control that. Yeah. What are some basic expectations around client services that you wish DeFi had? For example, CeFi offers monthly statements for clients, tax forms, preparations, etc. What would you wish for that, like the version of that to exist in DeFi?
I think like from our perspective, writing a lot of like risk related frameworks and methodologies, these don't actually bubble up to the user. So if there's like 100,000 sort of active wallets on Aave, like probably 1% of them know who we are, the people that are actually setting the governance parameters and sort of setting these ratings for them effectively. These don't come through the user experience or the wallet or the app. How to get that better is pretty important. Like having designers sort of in the DAO is probably pretty important, or something like that. I don't think everyone, it's very international. Every sort of DeFi protocol and app needs the same sort of tax forms, and I don't think we need to go that far. But actually understanding the risk you're taking, I'm not, of course, talking something I'm focused on, but it's a little bit blind, especially separate the APY.
I think for me, it's all about like how do we make it easier for users to like find the best yield opportunities and the safest yield opportunities. Like now that we have so many blockchains and so many applications, there's so many different yield opportunities to keep track of, and there's just isn't really any tooling out there to be like, hey, this is where all the yield on different chains are at one place. This is how easy, you click a button, you can participate in it, and then something to like also help you track like how these yields are meant to evolve over time and how safe each of these yield opportunity. I think today we're still very much in a world where as a user you kind of got to figure it out yourself, and a lot of times it's still trial and error, and you have to kind of guesstimate on how safe something is, and I just don't see how that's sustainable. If we really want to bring like trillions of liquidity on chain, all of this has to be like truly seamless, abstracted away, and so that like you don't have to be a DeFi power user to be able to use it.
Yeah, I think most institutions probably aren't going to be on VFAT tools looking for the latest.
I was thinking the same thing.
Yeah. But yeah, I think it's a combination of not just introducing to the users where the opportunities are. I think from the user perspective, that's really important. From more the builder perspective, I think security tooling is something that's absolutely key for the space to go forwards. And it's that on-chain monitoring, the reactionary, if there are issues that are arising, maybe with collateral assets, etc. I think that's really a key area that traditional finance has checks and balances in place. They have security systems in place. And I think that's something that a lot of DeFi protocols really need to focus on.
It's just the surface area is so much bigger, right? Like you have to think about your price fees, you have to think about your like numerous audits, you have to think about like other sorts of risks. And how do you think about that when you're just like a couple of software developers trying to ship some code? Kind of tough.
So moving on, with CeFi stablecoin products, there are a lot of counterparties that are involved. Why are there so many? What roles do they play? And could they be eliminated with payment stablecoins?
Yeah, in a CeFi stablecoin, typically there will be custodian banks, a network of custodian banks, brokers if you're holding treasury bills. And there will be auditors typically coming to provide a monthly or quarterly statement. I mean, typically around the issuers will be a network liquidity providers, OTC desk to provide the on-ramp and off-ramp services if the issuer does not choose to interact with all the market participants. That layer of liquidity is very much needed. So that's kind of is a basic ecosystem what it look like for issuing a stablecoin in a CeFi stablecoin. As you can see, that requires quite a lot of negotiations, partnerships, and incentives to make sure that basic structure is in place. Yeah, so it's costly.
Yeah. Moving on to L2s, a lot of new opportunities there. Very exciting, but also need to take account into risk. So what risk precautions do you think people should take when yield farming on new chains, especially L2s?
Most stables are not native or canonical. Circle, who was on before us, is trying to roll that out, starting with Arbitrum and announced a few others, I think, more recently. So if you have sort of bridged liquidity and it's sitting in a contract on mainnet, how do you think about that during that transition? That might be fine for you, right? You're going to pay like 5 to 10 basis points to get out of that. Maybe in the short run, if you wait too long, it could be more than that. But the bigger concern, if you have like exposure or your collateral or you're in one of these protocols, how does it shore itself up and prevent insolvencies? There's like this disjoint effort if you're sort of last mover. So basically, like the TLDR is if you're on L2s with a bridged asset, get out of there sooner than later and make sure that the protocol you're using has a good plan to sort of migrate to something native and canonical that can have liquidity and permanence there.
Yeah, we saw what happened with multi-chain when you don't have your canonical stablecoin, but a wrap stablecoin. It's only a stablecoin in name only. It's not actually USDC or DAI. It's wrapped that asset.
Yeah, I mean, exactly to what you said, right? I think whenever you look at a new chain, there's two major risks. The first is a bridge risk you mentioned, and then the second one is a protocol risk. And the bridging space and the cross-chain space have just had some of the largest hacks, and there's a terrible reputation. But us as industry participants, we just have to do better, right? Speaking of multi-chain, after multi-chain imploded on some of the ecosystems like Phantom, Axelar, we stepped in and provided more of decentralized Axelar assets, and we were helping a lot of the users and educating them on the difference. One of the things that consistently came up of frustration from users was that they didn't even know the USDC on Phantom was not a native canonical Circle USDC because it was just denominated as USDC. People didn't even know, right? And it's been around for so long, people just assumed it was safe. Like, I think one simple thing that we can do as cross-chain providers, we should always label our assets as a bridged asset, which is why at Axelar, for example, we always label our assets as AXL USDC or AXL USDT, etc., so that the users fully understand that this is not a native asset and it is leveraging Axelar's decentralized proof of stake security. And we believe that over time, right, people will learn, like, yes, Axelar assets are wrapped assets, but Axelar security is also the best in the space, right? When Uniswap did the cross-chain assessment for this exact reason, they went through a technical assessment of all of the cross-chain providers, and only Axelar and Wormhole, actually passed the assessment because everyone else was, quite centralized and quite opaque in how they're actually structured. So, with that said, as we see more and more L2s, we're starting to see lots of users, right, where they actually just use Axelar assets when it's available, and then when they participate in yield opportunity, they try to stay with Axelar assets. And on the protocol level, right, like there's always a risk with using like new dApps, right? Like even first, you should definitely check the regular things like have they been audited, who are the auditors. But to a certain extent, for new applications, there's always a risk that something could go wrong, smart contract risk or a rug pull. So, my advice for users is, not only use a trusted cross-chain solution, but also try to use a DEX or application that has already existed on other chains and has a great reputation.
Yeah, it's also exciting to see USDC deploying native USDC, I believe, on 6 different chains now. Frax did that earlier with Frax Ferry, where Frax Ferry is natively deployed on all these different chains. And I'm sure you're going to see that with more stablecoins just deploying natively.
Yeah, absolutely. And as a protocol that's really built around bridged assets and building on top of that, I think there's a couple of key points that we look at. There's the preemptive precautionary measures, which is not to have too much voting weight in the network or collateral limits tied to a single asset, so that you're having diversified risks, so that if something does happen, one of the underlying LSDs is compromised in some way, it's not going to be catastrophic for our own products. And then there's the reactionary side as well, which is what I think more protocols need to be building out, which is the automated on-chain methods where you're checking the status of the different collateral types and assets that are being utilized on your network. And if you see something that looks like something's amiss, a potential flash loan attack or minting bug, etc., being able to immediately and automatically freeze the use of that asset in your DeFi protocols, and then having governance look at what actually occurred there and taking mitigation measures after the fact is really important.
So, when creating a stablecoin yield farming strategy, what variables should one optimize for capital efficiency, and what risks should one take into account?
Sure. Same for similar for other assets. Realistically, you're looking at slippage and liquidity and how liquidators are thinking about it. As there's obviously been a push in like newer versions of pretty much every like DeFi protocol to have better capital efficiency. What I think most would be surprised by is that the correlation isn't always there between, for example, Tether and Frax, or USDC and DAI. Tether is actually quite the outlier. And while there is some like broken correlation events when like USDC has like an SVB crisis or something like that, you don't want to be bucketing these all in the same sort of considerations and the same sort of parameters.
Bonus alpha for everyone. Please share one stablecoin opportunity that humble farmers in the audience can take advantage of. If you can't share something, can you name something that excites you in the stablecoin space currently?
Sure, I can go first. So this is kind of a little secret that some of the DeFi power users have caught on to, which is that whenever Axelar collects to a new chain, we use Axel USDC as a routing liquidity, right? That powers a lot of our cross-chain applications. So we always need to bootstrap that liquidity fairly quickly, because otherwise the cross-chain application doesn't really have a liquidity layer, right? And it is just Axel USDC paired with USDC, so there's no impermanent loss, and it's a stable asset, right? And so in addition to all of the organic volume you're capturing through the cross-chain swaps, but in the early days, both Axelar and the DEX partner, typically Kyber or Sushi, we will be providing like incentives. So for the first month or so, it's often very, very juicy, and we have like whales who are just always keeping an eye out for when we launch a new chain to participate in this very attractive yield opportunity on chain.
Not financial advice. We also don't just do risk. We work with DEXs as well. We're working with the Uniswap Foundation, and just today we deployed Arbitrum incentives onto the stable pool Circle or USDC and Tether on Arbitrum. That will probably run at minimum 30 days and probably much longer if that pool starts to grow and show sort of elasticity.
Yeah, from a Tenet perspective, I think it's not just the opportunity to restake your LSDs and mint the stablecoin, but with the gauge system that we'll have, we'll be able to incentivize the use of LSDC across all the different DeFi applications that we integrate with. So if it's DEX liquidity that you're providing with LSDC, then that will get incentivized from our gauges. If it's a lending market, the same. So I think that as we integrate new protocols there'll be some really interesting opportunities that come up.
Yeah, for us, if you hold SBT, of course you earn 5% yield. But if we also, like we said, incentivize on-chain liquidity through the Curve SDBT and 3CRV pool. So we incentivize that pool right now, at least for the next 6 months. So if you provide a liquidity in that pool, I think that would give you a high single-digit stablecoin yield, which is quite attractive. So.
Yeah. Gareth, you mentioned that you have a gauge system. How is it similar to other gauge systems, and how is it different?
In terms of similarities, I think the base concept, obviously gauges really started with Curve and Vote Escrow Curve and incentivizing the different LP pools there. What we're doing a bit differently, so we incentivize different LSDs to be restaked to our network. So you can encourage smaller LSDs to have more of the asset restaked to Tenet, and therefore make the LSD itself more attractive for users. Which encourages decentralization away from a single dominant LSD issuer. But then what we're doing that's, in my opinion, quite innovative is incentivizing gauges for different DeFi protocols that utilize our assets on other networks. So it doesn't actually matter for us whether the user's on Tenet or whether they're on mainnet providing liquidity on Maverick, or they're on Arbitrum lending it out on Radiant Capital. Each of those can be incentivized from the same Vote Escrow system. So I think that's a really cool way to incentivize adoption.
Yeah, when I think of the original on-chain yield, especially at the start of DeFi summer, I think of the VE system. Everybody was chasing that kind of yield, especially with Curve and then Frax, and then like a year or 2 years later, everyone ended up adopting their own flavor of it. How do you guys think the VE gauge system experiment has played out, and where do you see it going in the future?
So as I see it, it's kind of like 3 stages of evolution of DeFi. The first kind of stage was the VE stablecoin yield farming, put it in somewhere, and lots of basically Ponzonomics where you're earning incredible APYs, but it's not coming from anywhere. Then we had the shift towards more real yield. So things like GMX, where you deposit into their LP pool and you're earning fees that are generated from their perpetual DEX, which obviously has some valuation. You can look at the model, see what the fees are generating, and determine whether that's good yield for you. And then I see the current stage that we're at as kind of the next step in that. It's still real yield, but you're now looking at things like real world assets as the real yield. You're looking at LSDs, which are essentially you're providing security as a service when you're staking these assets, and the LSD you're getting back is still representative of real yield. So I think building on top of that system next is what's really interesting for me. And with our gauge system, we're also flowing back to the holders of the Vote Escrow token, the fees that are generated from across our ecosystem. So whether it's transaction fees on the network, mint and redeem fees on the stablecoin. So I think it's about finding areas of real yield to distribute to your holders that is key.
So it's like a best of both worlds.
Yeah.
Complexity adds uncertainty, and a lot of gauge systems do that, adding
The true risk guy over here.
there's a lot of regulatory capture. I'm not going to name of protocols, but it's, again, never a free lunch. And some have seen that when, of course, someone wants to see a gauge and have it incentivize their protocol for XYZ reasons. If they have an ability to get cheap access to that money to gauge themselves and sort of feed themselves, they will. People follow incentives, as do protocols.
Yeah, I think as an ecosystem, we should have probably come up with a better word than bribe.
I like to say vote incentives. Yeah. Anybody have closing thoughts as we end the panel? Something that you'd like the audience to take away about stablecoin and stablecoin yield?
I mean, I think the future is going to be great for the end user. I think as we look towards future, based on the conversation today, I'm very optimistic that the future of stablecoins will be yield bearing. They will be more consumer friendly, and they will definitely be more liquid. We won't have to deal with some of the major stablecoins keeping all of the interest while leaving nothing behind for the end user. So it will be more equitable.
That's spreading the wealth I can get behind.
Yeah, I think for me, having been around the space for a long time, stablecoins to me were always the greatest opportunity for true adoption. of the blockchain and Web3 space. And I'm really excited about the future of that stablecoin space as we get new and innovative protocols coming along. So I think for me, it's the most interesting space to be building in.
I think the stablecoin wars, not just the existing ones, but with the payment processors, will be messier than any wars we've ever seen. But absolutely, the network effects and distribution of stablecoins have just been a boon for this industry and will just continue to do so.
I think I agree, and I'm positively both positive on the RWA-based backed stablecoin and also the kind of a native stablecoin backed like USD type of stablecoin. So I think there's going to be very intensified competition in the market. So it's good for consumers.
Yeah. All right. Thank you so much for joining us. Thank you everyone for listening.
Thank you.